Hello and welcome to the Currency Exchange, NatWest podcast, where we help to break down the major themes and events driving currency markets this week and in the weeks ahead. Today I'm joined by Alvaro Vivanco, who is our head of EMFX and ESG strategy. Alvaro, a lot of global factors have changed since we last spoke. How do you think these global factors have evolved in terms of EM currencies?
Hi, Eimear, and thank you everybody for joining us this week. Yeah, absolutely. The macro environment globally has shifted quite a bit in both directions, I will say, over the last few weeks since the last time we did an episode on emerging markets. I think obviously the big two drivers have been the US Fed, the central bank, the policy decision that they made to start with a pretty aggressive 50 basis points cut. And then, some very positive data in terms of growth and employment in the US that indicates that maybe there will be shifting to a lower and more modest pace of cuts moving forward. And that obviously, both of them, both directions have direct implications for the dollar and for emerging markets. And then the second one is China, right? And we've seen a couple of big announcements in terms of policy and the desire by Chinese policymakers to stimulate the economy a little bit more than before. And similarly to the Fed, this has to be put in the context of market expectations, right? So I think we were coming into the last quarter of the year with pretty high expectations in terms of what the Fed could do in terms of reducing the interest rates, which have been, fulfilled in terms of the initial cut, but also maybe a little bit less certain of the next steps, where economists think that in terms of the terminal rates, the rates at the end of this period of easing remain relatively low, right? And those have been more anchored than how exactly we get to that terminal rate. And in terms of the Chinese developments, I have to say that the bar for the market for policymakers and the central banks in China to meet those expectations is actually quite high, right? What we've seen is a little bit of disappointment in terms of exactly what needs to be signaled and the specific amounts in terms of credit easing, measures to stimulate the real estate sector, the fiscal stimulus. The market is, I don't think necessarily looking for more, but is looking for more specifics of exactly how much we can expect over the next few months. So it's been I would say a more uncertain environment for markets. Also, obviously, we're heading into the U.S. election, which maybe we can discuss in this podcast as well. So, there are just more sources of uncertainty out there. The overall stance for us, and it has been since pretty much the summer, is that we're guiding our emerging market views on fundamentals, right? On what's happening in the countries. Obviously, these external factors matter a lot, but we're looking at fundamentals in each country and valuations for the FX in particular, which for the most part remain pretty attractive for emerging markets. Not all of them, but for the majority of them, especially in terms of currencies, we see value in a few places.
Yeah, definitely. I think when the global factors seem so much in flux, it's kind of nice to go to the safety of those kind of relative value trades, which hopefully have less beta to global outlook. And I know you were in Europe recently, and we saw a lot of clients together. What were the main questions clients were asking about EM?
I think for clients, they want to be positive EM. That was the general impression that we got. So there is optimism that valuations will eventually come to dominate markets, and that there's value. There's agreement that there's value in a few places. I guess the two questions that we got from clients were, the first one is, why haven't emerging market currencies performed better over the last couple of months and few weeks, right? That the general environment is actually quite positive. We're getting some positive surprises from a few factors globally. Why haven't we seen that driver? And I guess the immediate answer is that a lot of investors are still waiting for the resolution of the U.S. election. I have to say the scope for emerging market currencies to really react negatively to one of the two outcomes is much lower than in the past. So I don't think necessarily investors are worried that a particular outcome of the election is going to be very negative for emerging markets growth and fundamentals, and even for currencies over the medium term. It's just that given the fact that it's very uncertain, it's a very binary choice. There's a lot of policy choices on the table, right? That Trump has talked about tariffs, has talked about fiscal stimulus. There's a lot of potential changes down the road. And I think most investors, going into this big event this late into the year, with all these uncertainties, have preferred to be a little bit more cautious. And the general impression that I definitely got is that there's not a lot of risk in EM or in risky assets for that matter, other than U.S. equities at the moment. That people are just waiting. And then the second question, which is a lot more specific, is what's happening with the fiscal situation in emerging markets, which I think is a very, very good question. I think it's going to become more relevant. What we've seen is that in a lot of countries, there's been a lot of pressure for politicians to spend more. In some cases, they're taking advantage of the market being a little bit less worried about inflation, for sure, globally and in their own countries. Central banks have been easing rates, and in most cases will continue to ease rates. And the fiscal pressure is starting to come up as a big risk. We'll have different views depending on each country, but those are certainly the things that are in investors' minds at the moment.
Does that change your short-term view on the currencies?
I think that, we just put a report out this week, and the basic points that we're making is that, yes, we have to be aware that there are more uncertainties, certainly over the next few weeks. We still think that the overall global backdrop is positive for emerging markets, right? So China is doing more. They have committed to doing more if necessary to sustain a reasonable level of economic growth, right? We're never going to go back to the 6% growth that we had in China. But at the margin, I think it reduces the probability of a severe downturn in China, which obviously still matters. It's a lot less relevant for emerging markets and global risky assets, but still China is a big economy. It matters. And on the whole, I will say compared to our expectations a few months ago, the announcement of the measures have been positive. And again, the Fed, maybe there's a little bit more fine tuning of the cycle, but at the end of this period, we still think that the dollar carry, which has been a big factor of why the dollar has performed so well over the last few months, that carry will decline a lot more than the decline in carry in emerging markets, right? So for a lot of central banks in emerging markets, they are already quite advanced in terms of the easing cycles. In the case of Brazil, which is the outlier, they have started hiking rates, but we think the carry differentials will be positive. So, we remain pretty constructive. Also, levels are back at valuations where we think are very, very attractive on a medium to long-term basis. So for the short term, I would say we're doing a little bit more relative value within EM, funding some of our long EM positions, not necessarily against the dollar, but other emerging markets or other G10 currencies. That's something that we look to do over the next few weeks. But in general, we remain constructive, and we think that a conviction level on the ones that have the fundamentals and the positioning and the external backdrop supporting it, it's actually higher. Given that, especially in the last couple of weeks, this month, emerging market currencies have weakened against the dollar.
Mm. And as you said before, we do have a very big binary risk ahead of us in the short term in the form of the US election. Do you see any particular risk for emerging markets coming from that election outcome?
I mean, the obvious ones and the one that really moved last time was Mexico, right? I think in this case, it's very different. It's different. It's different because we already know a lot of the policy noise and uncertainty that could come under a potential Trump presidency. We know that Mexico is capable of negotiating on certain policy priorities for the U.S., especially the asylum applications in the border. That was kind of the threat of tariffs that was posed, back during the first Trump administration, and I think Mexico handled that relatively well. There's also already happened the big renegotiation of the trade agreement. There could be things at the margin that are tweaked, but I think for the most part, the risk for Mexico compared to the rest of the world, right? There's some uncertainties for all countries, but I think the Mexican peso as kind of the trade for this election has lost a lot of relevance. Also because we're at very, very different levels, right? The peso is back close to 20. That is a big move from levels below 17 that we saw earlier this year. So the big sell-off for the Mexican peso has already happened, in part because of the Fed, also the local elections and all of that. And I think just valuations got a little bit too strained. So I don't think that that's going to be the big move. I think on your region, you have been signaling Poland as a more interesting, maybe longer term, maybe not something that we put before the elections, but something that has a little bit more momentum. And I think that that's kind of the overall message for emerging markets as a whole, is that this is a big event. It has potentially big consequences over the long term. We think that positioning is very light coming in. It will be a shock, I think, to emerging markets in general if Trump were to win. To us, that would probably suggest better entry points for the currencies that we like and we think the fundamentals are aligned with. So we're sticking to our core position of trading around elections with these core positions, in a 3 to 6 month horizon.
Yeah, absolutely. As you said, in the senior reason, definitely it's kind of Poland, which is kind of on my risk radar for a Trump election outcome. I think the one thing Trump has been very consistent on is that he's looking for a swift end to the conflict in Ukraine. And we think that really risks emboldening Russia, especially if that involves Ukraine basically ceding territory. So this is not something to instantly price in. We do think the risk that you get kind of more destabilizing events in Poland, with authorities signaling that it's Russia behind them, will really increase the geopolitical risk premium that could be priced into the currency. Also, kind of Poland is a bit of an outlier in terms of the global easing cycle. It kind of very early on paused its easing cycle. And now it looks like it's going to be restarting just as other central banks kind of approach the very end of theirs. So for us, we're kind of looking at a very stable trajectory for the Polish zloty over the next 3 months, but with big downside risk into H1 of next year. Well, Alvaro, thank you so much for joining me today. That's probably about all we have time for. But if you did like the podcast, please do click like and remember to subscribe so you get the latest episode first. Thanks again for joining us.